The S&P 500 is the benchmark for the U.S. stock market. It represents the performance of 500 of the largest publicly traded companies in the United States, spanning various industries. This index is widely regarded as one of the best gauges of the overall health of the U.S. economy and investor sentiment. It's a broad index that covers 500 of the largest companies. These companies are leaders in their respective sectors, including technology, healthcare, finance, and consumer goods. The S&P 500's diversity makes it a reliable indicator of the market's overall performance. Futures contracts on the S&P 500 allow investors to speculate, letting them bet on the future direction of the market. These contracts are financial instruments that derive their value from the underlying S&P 500 index. By trading futures, investors can gain exposure to the market without actually owning the stocks in the index. These futures are traded on the Chicago Mercantile Exchange, or CME, and are used by traders of all sizes. The CME is one of the largest and most diverse derivatives marketplaces in the world, providing a platform for trading a wide range of asset classes, including equity indexes, interest rates, and commodities. Futures contracts are agreements where buyers and sellers agree on a price and a future date when they will buy or sell an asset. These contracts are standardized, meaning they have specific terms and conditions, such as the contract size and expiration date, which are set by the exchange. The asset, in this case, is the S&P 500 index. By trading these futures, investors can hedge against potential losses in their portfolios or take advantage of anticipated market movements. This makes S&P 500 futures a versatile tool for both risk management and speculative purposes. These contracts are standardized, making them easy to trade. The standardization ensures that all parties involved in the transaction have a clear understanding of the contract's terms, reducing the risk of misunderstandings and disputes. They can be used for various investment strategies. For instance, institutional investors might use S&P 500 futures to manage their exposure to the stock market, while individual traders might use them to speculate on short-term price movements. Additionally, these futures can be part of more complex trading strategies, such as spread trading or arbitrage. The S&P 500 futures have been down for 3 consecutive sessions. This downward trend has caught the attention of many investors and analysts alike, raising questions about the overall health of the market. The consistent decline is not just a blip on the radar, it could be indicative of deeper issues within the economy. This is a sign that the market may be losing momentum. Analysts are closely monitoring various indicators to understand the underlying causes. Some believe that this could be a temporary correction, while others are more pessimistic, suggesting that it might be the beginning of a more prolonged downturn. Investors are getting nervous, concerned about the economy, worried about inflation, and considering the impact of interest rate hikes. The Federal Reserve's policies are under scrutiny, as any changes in interest rates could have significant repercussions on the market. The fear of rising inflation is also causing jitters among investors who are unsure how it will affect their portfolios. The decline in futures is not insignificant. It has erased gains from earlier in the month. This has led to a reevaluation of investment strategies, with many opting to move their assets into safer, more stable investments. The volatility is causing a lot of uncertainty, and investors are looking for ways to mitigate their risks. This suggests a shift in sentiment. The optimism that characterized the market earlier in the year is waning, replaced by a more cautious approach. Financial news outlets are buzzing with discussions about the potential for a market correction, and traders are reacting to every piece of news with heightened sensitivity. Investors are becoming more risk-averse and are pulling back from the market, at least in the short term. Financial advisors are busy consulting with their clients, helping them navigate these turbulent times. Risk management strategies are being revisited, and the focus is shifting towards preserving capital rather than seeking high returns. The coming weeks will be crucial in determining whether this is a temporary setback or a sign of more significant challenges ahead. The Federal Reserve has been raising interest rates to combat inflation. Higher interest rates make it more expensive to borrow money, which can slow down economic growth and impact corporate profits. When interest rates rise, investors reevaluate their portfolios, looking for safer investments. Bonds become more attractive as they offer a fixed return, making stocks less appealing. This is especially true for growth stocks, which are more sensitive to interest rate changes. The geopolitical landscape is uncertain. The war in Ukraine continues, and tensions between the US and China are high. These factors contribute to market volatility, causing investors to look for safe havens. Geopolitical events can impact the market in many ways. They can disrupt supply chains, lead to higher energy prices, and cause uncertainty. This uncertainty can make investors hesitant to invest in the market, which can lead to lower stock prices. Section 5, Energy Sector takes a closer look. The energy sector has been hit hard. Over the past few months, we've seen a significant decline in the value of energy stocks. This downturn has been driven by a combination of factors, including geopolitical tensions, market speculation, and shifts in global energy policies. Investors are becoming increasingly wary, and the ripple effects are being felt across the entire sector. One of the primary reasons for this decline is the falling oil prices. The price of crude oil has seen a sharp drop, which has had a cascading effect on the entire energy market. This decline is not just a short-term fluctuation but appears to be part of a longer-term trend influenced by various global factors. Oil prices have fallen in recent weeks, and this trend shows no signs of reversing anytime soon. Analysts are predicting that we may continue to see low oil prices for the foreseeable future. This has led to a lot of uncertainty and volatility in the market, making it a challenging environment for investors and companies alike. This is due to concerns about global demand. As economies around the world grapple with various challenges, the demand for oil has been inconsistent. Factors such as the transition to renewable energy sources, changes in consumer behavior, and economic slowdowns in key markets have all contributed to this uncertainty. A slowdown in economic growth would lead to lower demand for oil. When economies slow down, industrial activity decreases, and the need for energy diminishes. This is particularly evident in sectors like manufacturing and transportation, which are heavily reliant on oil. The reduced demand puts additional pressure on oil prices, exacerbating the decline. The energy sector is cyclical. It goes through periods of boom and bust, influenced by a variety of factors including technological advancements, regulatory changes, and shifts in consumer preferences. Understanding these cycles is crucial for investors and companies operating in this space. It is sensitive to economic conditions. When the economy is doing well, the energy sector typically thrives. Conversely, when the economy is struggling, the energy sector often faces significant challenges. This sensitivity makes it a particularly volatile sector, requiring careful analysis and strategic planning. When the economy is strong, demand for energy is high. Businesses expand, production increases, and consumers spend more, all of which drive up the need for energy. This increased demand typically leads to higher prices for oil and other energy sources, benefiting companies in the sector. This leads to higher oil prices. As demand outstrips supply, prices naturally rise. This can be a boon for energy companies, leading to higher revenues and profits. However, it can also lead to higher costs for consumers and businesses, potentially slowing down economic growth if prices rise too quickly. When the economy weakens, demand for energy falls. Businesses cut back on production, consumers reduce spending, and the overall need for energy decreases. This reduction in demand puts downward pressure on prices, which can be challenging for energy companies that rely on higher prices to maintain profitability. This puts downward pressure on oil prices. As prices fall, energy companies may struggle to cover their costs, leading to potential cutbacks in production and investment. This can create a vicious cycle where reduced investment leads to lower future production, further impacting the sector's long-term stability. Section 6, Tech Sector Uncertainty, a mixed bag for investors. The technology sector has been a mixed bag. Some tech giants have reported strong earnings, others have issued warnings. They warn of slowing growth. This uncertainty has led to volatility in the sector. The technology sector is driven by innovation. It is also driven by consumer spending. When the economy is strong, consumers spend more on technology. When the economy weakens, consumers cut back. This can impact the tech sector. Section 7, Analyst Perspectives Deciphering the Future. Market analysts are divided. Some believe the market is due for a correction. Others believe the bull market will continue. They point to strong corporate earnings. They point to a strong labor market. It is important to note that analysts often disagree. They have different opinions. They use different models. They have different time horizons. Investors should consider a range of perspectives. They should not rely on just one analyst's opinion. Section 8. Navigating the current market investor considerations. Investors should be cautious in the current market. Volatility is likely to continue. Investors should focus on their long-term goals. They should have a diversified portfolio. It is important to remember that investing involves risk. There is no guarantee of returns. Investors should carefully consider their risk tolerance. They should consult with a financial advisor if needed. Section 9. Conclusion, volatility, and the road ahead. The S&P 500 futures are pointing to a period of uncertainty. Investors are concerned about a number of factors. These factors include interest rate hikes, inflation, and geopolitical tensions. These factors are contributing to market volatility. The road ahead for the market is uncertain. Investors should be prepared for continued volatility. They should stay informed about market conditions. They should be prepared to adjust their investment strategies as needed.